Hey everyone, in this video we're going to be looking at some stocks that I believe are on sale, and all these stocks we're going over I do own, so I might be a little biased, but I just like being completely transparent. I'll show you how many shares I own, how much I'm up and down on them, and what did I just buy. Like, check this out. One of the stocks we're going over is McDonald's. They're down 9% the past month, and I just decided to pick up another share of this company. I got 14 shares of McDonald's now, one of my largest holdings. Yeah, I just bought another share at $290, and hey, look at that, we also got some dividends. $23 dividend, $23 dividend, which is pretty cool. So McDonald's is one of my heavy hitters. But the first stock I actually want to go over is one here in my Webull portfolio. And by the way, this is not financial advice. I'm not an expert. I'm just a college student who likes talking about stocks. So the first stock I actually want to go over is one I'm down on. This is ticker symbol TAP, Molson Coors, and they own a lot of beer and brewery brands. If you've probably heard of Molson Coors before, but check this out. I'm going to show you why this company is at a phenomenal deal right now. I actually don't believe it. They have a 3.85% dividend. So you get a near 4% dividend, and look at the PE ratio to the left of that. The forward PE is lower than the trailing 12 months PE. That means they're expected to grow their net income. So this is a company that's expected to grow their net income, and they're trading at 8 times PE. And the thing is, they just sell a commodity, they just sell beer, they just sell drinks. So I get why they probably traded a low PE. But check this out right here. I mean, look at the net income that they're making. They kind of had a one-time adjustment in the most recent quarter, but usually, actually, let's average out the 4 quarters here. They're easily making, 250 million of net income a quarter. So remember that. This company makes at least 250 million of net income a quarter. And look at the dividend. It only costs 99 million. So that near 4% dividend is at a safe 40 to 50% payout ratio, or actually lower than that. And since they have so much leftover money, since the dividend payout ratio is so low, they're doing a lot of stock buybacks. Check that out. I mean, that's crazy. If you go to the total common shares outstanding, look at that. So not only do you get a 3.9% dividend yield, but you own 4.5% more of the company than you did a year ago. That's the best part about this company, are the share buybacks. Check this out. In the most recent quarter, there are 202 million shares. Let's go to 2019. I mean, it was 216 million. So from 216 to almost under 200 million now. That's a huge deal. And let's see, they still got 400 million of cash, not bad. So yeah, very shareholder friendly company. They own a lot of beverages. So let me know what you think about Molson Coors. I do own this one. I got 11 shares of this company, and they're kind of like McDonald's. Look at them the past month here. They're at a reasonable valuation. So this is one that I think is a set it and forget it kind of company. $9.4 billion market cap. They own, I love Molson Coors, one of my favorite beverages. But anyway, that is ticker symbol TAP. And the next stock I actually wanted to go over is, of course, McDonald's, because I did just buy this one. They are down 9% the past month, and I'm really not too sure why. They did just close all those Cosmix locations, if anyone's heard of that. They were opening these stores to be like a Starbucks competitor, but they ended up closing down all of them. Again, this is less than $100 million loss for them, and they make a ridiculous amount of money. But anyway, here's my position in them. We're up only 5% all time in here, and like I kind of showed at the beginning, we just bought another share literally yesterday at $290 a share. And I love the dividends from this company. They pay $1.77 a quarter. Morningstar has it at a 312 fair price target on McDonald's. And here's the thing. McDonald's isn't just a restaurant. They're actually a royalty real estate company. If you go spend $100 at McDonald's, $4 of that is a royalty that goes back to McDonald's corporate, or this stock right here. And they also own the land under 80% of the stores. But anyway, check this out right here. Here's the net income that they're making. It's very consistent. It's roughly $2 billion a quarter. If we kind of average it, it's right at $2 billion a quarter. The cash from operations is a lot better, and you do kind of want to look at that. But anyway, we'll just look at the net income. Let's not give McDonald's the benefit of the doubt here. So they make, $2 billion of net income a quarter. And let's see, the dividend cost $1.3 billion. So that is a little bit of a high payout ratio. It's like a 60%, but this is like a pseudo REIT, a real estate investment trust. And that's why it's okay. And they're also doing a bunch of share buybacks as well. Check that out. They've kind of slowed it down in the most recent quarters, only 400 million of buybacks a quarter. But look at that. This company is never diluting. You look at that. They're normally spending like $1 billion a quarter on share buybacks. So it's very cool to see that this is a shareholder-friendly company. We can see their property, plant, and equipment, $45 billion of assets. If they were to convert to a REIT, they'd be in the top 10 largest REITs in the U.S. So anyway, McDonald's shareholder friendly company. I love the business model. If we go into a recession, McDonald's will actually benefit. In 2008, when there was a recession, McDonald's took advantage and they opened up a bunch of new stores. They acquired a bunch of cheap land. If we actually go back and look at the stock price, they have one of the best charts for any blue chip out there. Once 2008, yeah, you wouldn't even tell. Look, this is the year 2008 right here. They never even dipped. They were flat. McDonald's and Walmart were two of the best performing stocks in the S&P 500. But anyway, McDonald's, you should just get 6 to 8% of your money back every year with this company. 2% dividends or 2.44% yield, 2.5% dividends, probably 2% from buybacks, and 2% same store sales growth. So anyway, McDonald's, I really like that one. I do own them. They're one of my largest holdings. It's exposure to real estate, you get exposure to royalties, and it's a recession resistance play, and you get a nice yield. So anyway, McDonald's is one that I like. Again, I don't expect McDonald's to outperform the S&P 500 in the long run, but what you do get is just a safe and reliable stock that should return 7% a year. So anyway, yeah, here's my total percent change on every stock in here. This is my dividend growth portfolio. McDonald's is the highest yielding stock in here. But yeah, a lot of these are like dividend growth companies. But anyway, let's get to this next dividend stock that I think is a great one. All right, guys. So for this next stock we're going over, this is one I own here in my Moomoo portfolio, which is my buy and hold portfolio. Once I buy a stock in here, I try and just never sell it. I just try and keep it for the long run. And one of my newest purchases is actually Coca-Cola Consolidated. This isn't the normal Coca-Cola. This is the bottling company, and they're at quite a discount, kind of like McDonald's, I think, right now. McDonald's and Coke, they're kind of similar companies, but or they sell stuff together. But anyway, look, they're $140, and now they're $106 a share. And I've been buying them down here. Look at that. I bought a share here, and I bought 2 shares on the 2 most recent days. So anyway, let me show you what I love about Coca-Cola Consolidated. Yeah, let's check them out on the Moomoo app right here. They trade at a 16 PE. So that's a very fair valuation, 16 times net income. They just bottle non-alcoholic beverages like Topo Chico or all the Coca-Cola products. They actually even bottle for Monster and some Dr. Pepper products as well. But anyway, if we look at this right here, this is why the stock, I believe, is falling so much. If you look at them, the stock has definitely fallen from its peak, $146. Why is that? I think it's because of this net income slowdown. The net income actually fell 37% year over year, but they had some explanations like there were 2 fewer selling days in here, and one was like a holiday. So basically, we got to look at them over here. So if we go and look at Coca-Cola on their diluted normalized DPS. So yeah, this is a dividend payer as well. You get a 1% dividend yield. If you look in the middle of my screen right here, they have a 1% dividend. They pay you 25 cents a quarter. So you get $1 back every year. And check this out right here. If we look at the diluted normalized DPS, they just did a stock split. So you see how it says they did a 10-for-1 stock split. So that's why it looks like this. Anyway, you want to ignore that. In the most recent quarter, it was $1.39. So they made $1.39. It's always over $1. They're usually making $1 to $2 of diluted normalized DPS. The dividend only costs 25 cents from this. So the dividend only costs 25 cents here. I'll show you that right here. It says 2.5. That's not including the stock split. So it's actually 25 cents a share. Anyway, let's keep going. I want to show you another great thing about this company, and that's the amount of share buybacks that they're doing. I mean, this is such a shareholder-friendly company. Check this out. Literally 2-3 quarters ago, they spent $600 million buying back their own stock. Good news. Look at that. I can go back all the way to 2016. They haven't diluted you a single time. They never dilute you, but they give you more ownership in the company via share buybacks, which is great news. And look at their total long-term debt right here. Their total debt, it actually went down. Look at that. It was 1.79. Now it's only 1.44. But anyway, they have $1.44 billion of total debt, and they have $1.49 billion of cash. So they have more cash than debt. They could pay off all the debt if they wanted to. So that means anytime they make free cash flow or net income, they can do whatever they want with it. They don't have to pay it off in debt. They can return it to shareholders through dividends and buybacks. Like, they just rose their dividend. Great news. So Coca-Cola Consolidated, this is a great company in my opinion. Low valuation, nice dividend growth. This hasn't updated right here, but look at this right here. They have a 0.56% dividend yield. It's actually, this is for the full year 2024. The yield's higher now. It's a 1%, but the payout ratio is only a 5.7%. So that means if we assume the dividend yield's now a 1%, that means the payout ratio is only a 10%. So you get 1% of your money back a year in dividends, and the payout ratio is only a 10%. So that's what's so cool about Coca-Cola Consolidated, and that's why I own them here in my buy and hold portfolio. Again, don't listen to me. I'm not an expert. Again, you always do your own research. I'm just a college student. I recommend if you want to buy a stock, you should DCA into it, dollar cost average like I did down here. But it doesn't always work out. So make sure you're dollar cost averaging into a high quality company. So yeah, that was the video. Make sure to check out this one up here. I'd really appreciate that as my previous video. I think you'll like it. Also, don't forget to drop a like on the video. I'd really appreciate that. And if you leave a comment, I will respond to all the comments. So anyway, I hope you have a fantastic rest of your day. My name's Nathan Roberts. See you in the next one.